Hello again, this is me, Eddie Levi, the tax guy. So I have a quick question for you. Do you know the difference about standard deduction and itemized deduction? Have you ever heard about it? Wait, what are you looking at me for? You want me to answer? But I'm the one that asked the question. But I got to answer. All right, so let's answer this. So the difference about the itemized deduction, standard deduction. Let's go standard deductions. Let's go deduction overall. So when you have the gross income that's going to be taxable, your deduction is going to minimize the total of your taxable. Yeah, so that deduction is going to minimize the total of the gross income that's going to be taxable. So some people actually take the standard deduction and some people actually go for the itemized deduction. I always tell the client, hey, do whatever is more advantageous to you and do whatever you have. So, for example, if you're single and your standard deduction for 2015 is 6,300, that's one of the things about it. If you're head of household, meaning you have a dependent and you take care of more than 50% of the household items, your standard deduction is 9,250. If you are married filing jointly and you have a married spouse, meaning you guys live together and you guys are a spouse and you are married, your standard deduction would be 12,600. And for those that are married filing separately, some people are married but they want to file tax separately because they have different taxation, different items, or just maybe because of financial situation, their married filing separately deduction is the same as single, which is 6,300. So people ask about it. It's like, okay, that's going to be minimized. That's going to be subtract out of my whole gross income and whatever is the amount. They're going to be taxable minus this. It's going to be amount going to be taxable. Well, you got to remember, if you have items that you can itemize your deduction, meaning if you pay real estate taxes, if you pay home mortgage, interest that you pay, if you have medical expenses that are over 10%, all right, medical expenses got to be over 10% of your total gross income, right? So it's got to be 10%. If you have dental expenses, if you have gifts that you guys send to different charities, for example, Salvation Army, or things that you guys donate to different nonprofit organizations, or even money that you give it to church. In the end of the year, the church was going to send you, this is how much money gave us as a stipend. That's also deductible. You can also have job expenses. You can have real estate taxes, but you can also have state taxes. You can also put towards the itemization. You can also put miscellaneous deductions towards the itemization, and you can also put, there's a 2% gap on it, meaning 2% that you can do on it. It depends on the situation. You have to look in IRS website, and I'll go over it later on. If you have some casualties or loss on your primary residence, you can be itemized as well. Okay, so you got to remember, if you have itemization and it's above that standard deduction amount, and go for it. Put your itemization amount there. If it is way above the standard deduction, do the itemized deduction. If you have itemized items and it's way below the standard deduction, take the standard deduction. All right. Always take what's more advantageous to you, so you can pay less taxes. All right. So this is Eddie Levi, the tax guy, once again. One thing, guys, if you have any questions, please leave your comments below. Or if you want me to do any podcast about any questions about something that you have questions, once again, leave your questions below. All right. Take care and you have a wonderful evening. Bye.